saying some of the inflation impacts are permanent for his business, including for wages. Ira Robbins is the president and CEO of Valley Bank, a major player in New York, New Jersey, and elsewhere. Mr. Robbins, welcome. Nice to have you back.
Thank you. It's great to be here today.
Let's talk about what you expect the Federal Reserve to do beginning tomorrow and how that will change the playbook for banks like yours.
I think I would continue the Fed to continue to message that there is going to be a wind down of some of the monetary policies that they put in place and lead to a potential rise in interest rates going into 2022. Generally speaking, for bank stocks, rising interest rate environment is a real positive. It leads to an increase in the slope of the yield curve, which for spread banks like Valley would inure to the bottom line and be very accretive to the overall earnings. I think one additional factor that we have to consider this year that maybe we haven't had in past increase in rate environments is the amount of stimulus that's currently in the market today from a monetary and fiscal perspective, and what that does simply to deposit rates. And I don't think banks are going to be pressured to raise deposit rates in the manners in which they were in previous rising interest rate environments, which once again would be a benefit overall to traditional bank stocks.
Yes, good for the banks, maybe not for the savers, but that's what we've come to get used to. It's basically the difference between what you pay for deposits and what you're able to lend money for. Let's talk about inflation and how it is affecting you, because we led into this saying that you see inflation being less transitory and more permanent. I can see that, but once wages go, I think a lot of the wage inflation has been a kind of catch-up phenomenon and a labor shortage phenomenon, and that once this lump of catch-up is over, that the rate of wage inflation will slow markedly. That's not to say that those wage increases are going to be taken away and you're going to have deflation of wages. I think the higher wages are here to stay, but the rate of growth is probably more transitory than not. What do you say?
I would tend to agree with you 100%. I think what we've seen from a wage increase percentage is here. It's difficult for an employer to give back the wages that we've already provided. The pace is definitely going to slow down as we see more workers come back. We're still seeing millennials not at the same participation rate that we were pre-pandemic. So I do believe that the increase in wages are going to slow down. But I believe that there's a few other factors that are going to impact permanent inflation increase across the entire country. I believe from an environmental perspective that we are finally, as a society, beginning to understand the true costs from an economic and environmental perspective of some of the cost processes and services that we put in place. And now these are finally beginning to push through to the overall consumer. I think this is still going to continue to push inflation up as we think about pricing moving forward.
What do you mean by that, Ira?
I think, I was with a customer the other day, and just for them to refit some of their manufacturing plants to be more consumer or to be more environmental friendly, 10 to 15% increase in what that manufacturing cost is. I think as a society, we've gotten away far too long without understanding the true environmental costs for some of the manufacturing that we've done across this country. And I think rightly so, some of these costs are now going to be embedded back into the cost of production. And as a result, there's still going to be continued pressure on inflation as we migrate towards understanding the true economic cost of some of the environmental policies that we put forth.